Happy Sunday, everyone. This is RJ Baxter with Fairway Independent Mortgage, and I just wanted to share with you guys another chart that I came across. This is from my friends at MBS Highway, which is a service that we subscribe to that helps us to track the markets and gives us real-time alerts during the day if we're getting changes in rates and that sort of thing. And this is a chart that shows the relationship between mortgage rates and recessions. I was talking on Friday, I shared another chart from these guys that correlated the unemployment rate to a possible coming recession. And there's been a lot of different indicators, a lot of talk on the news and amongst economists as to when and if a recession is coming. And the consensus is that this is likely something that's coming here in the not too distant future, 12 to 24 months type thing. So I wanted to talk today about the effect of recessions on mortgage rates and how this can be a way to approach your mortgage strategically, especially with rates up right now. And this chart shows, going all the way back to 1972, you'll see here how interest rates rise, and then it tends to lead to a recession. And then during the recession, rates tend to come down. And during a lot of these recessions, you'll see that after the recession, the shaded area is the recession, by the way. After the recession, rates continue that downward trend historically. So if we look at more recent ones, here's the tech crisis or tech bubble. You'll see it went down during the recession, leveled out a little bit, and then kept going down. And then during the Great Recession, of course, rates went down. And then during COVID here, rates went down as well and then kept going down after the recession. So why is this important? We've all seen in the news, and you know this if you've talked to me or any other lenders, that rates have gone up lately. But this is not necessarily something to fear. We're still at near historic lows. Primary residence rates around 5% if you follow this line across. I mean, this is, before the Great Recession, about the lowest we'd ever seen. So rates are still very good. But that being said, as things like inflation, the Federal Reserve raising rates, things like this rising rates, put pressure on the economy, this could throw us into recession here in the not too distant future. And if that happens, rates are likely to come down. So what this means is it's wiser on a mortgage transaction to look at, you're going to think I'm crazy, but locking a slightly higher interest rate than what the quote-unquote regular rate is. There's a term we use in the business called points. 1 point is equivalent to 1% of the loan amount. It's a fee that's charged at closing. And another term for this is buy-down points. And this is used in an effort to buy the rate down. So, for example, if the going rate is 5% without points, if you pay 1 point, the rate might be 4.75. Well, it can go the other way as well. We could lock a slightly higher rate, 5.25, let's say, and credit you a point. And that 1%, that point, can be used as an offset to the fees. Now, if a recession comes and rates come down and your interest rate's 5.25, there's a very good chance that you're going to have a chance to refinance at a very much lower rate within the next 1 to 2 years, maybe 3 years, we'll see. But if that's the case, it's much less expensive to pay a little bit higher interest on a 0.25% higher interest rate than it is to pay an extra X number of dollars of closing costs at closing. So this is why this can strategically be a good way for a long-term plan to obtain a lower rate at a lower cost, and you pay the closing costs on the refinance. So I hope that makes sense. I can definitely put that together for you on more specific numbers if you'd like to look at that or have any other questions mortgage related. We are watching today and always, so just reach out by phone, text, or email, and have a great rest of your Sunday. Thanks for watching.